All right, traders, welcome back to the boot camp. It is currently day 3, and now things are about to crank up. Obviously, day 1 we went over getting a broker, downloading MetaTrader 4, getting the bare bone basics out of the way. And day 2 we discussed all about risk and understanding that this overall is an absolutely risky business, and it's very hard. But if you can take advantage of risk and take advantage of the numbers, basically math, you can make money without having to force yourself to win every time. So now that we got that out of the way, I wanted to provide that framework for you before we got really into things. And now we're going to start getting into Forex. You know, the most common question that is asked of me is questions along the lines of what is Forex and what is this term, what is that term. Well, today's video is meant to give a groundwork to the terminology and a little bit about Forex, and it's going to help you not only understand it, but the more you understand these concepts, the easier learning will be, because once I can show you the definitions, the terminology, the sentences that I say will become much easier. So today we're going to discuss, basically the main question of what is Forex. And so first things first, I'm going to read you an excerpt from just a broker website. And this one came from fxcm.com. And Forex, also known as the foreign exchange or FX or currency trading, is a decentralized global market where all the world's currencies trade. The Forex market is the largest, most liquid market in the world, with an average daily trading volume exceeding 5 trillion. And actually, since they posted this, it's actually increased higher than that. There is no central exchange as it trades over the counter. Forex trading allows you to buy and sell currencies similar to a stock trade, except you can do it 24 hours a day, 5 days a week, and you have access to margin trading, which we'll discuss in a minute, and you can gain exposure to international markets. Meaning, yes, this is the largest financial market in the world. The funny thing is that everybody knows what the stock market is. You hear about it all the time, and it's always on the news. But very, very few know what Forex is, even though it trumps it by trillions. And it's an important market, and this market of all markets is something that I've taken advantage of full and wholeheartedly, and I've been able to take advantage of it in so many different ways. So what I want to do, this is just that fancy definition. And the reason I showed you this was just so that you have a textbook example. But what I want to do now is get away from the definitions and bring it into your terms, bring it into my terms, and show you an example of how I, talk about Forex with people. So when people come to me and they ask, what do you do, or what is Forex? Basically, I provide an example similar to this. So first, paint this picture in your head. You would like to take a vacation to Europe from the US. And when entering your destination, which is Europe, you're going to have to convert your dollars to euros. If you guys have ever been in an airport, have you ever seen those stations where they will convert your currency? Notice it says the foreign exchange or Forex. That money conversion there counts towards that 5 trillion. That's what a lot of the money comes from. And so people are constantly converting their currency. And so you go and you convert $1,000 to euros at this time. But as you land in Europe, your friend that picks you up then decides that he or she will pay for everything. Meaning you have no need to spend money. No need to spend money on food, on clothing, on little trinkets or anything from traveling. All that money that you had, that $1,000 that you switched into euros, for all intents and purposes, is now put into a safe. And a week later, a month later, doesn't matter. When leaving for home, you convert your euros back to dollars. And once again, for all intents and purposes of the money, when you went to Europe, your $1,000 was worth 1,000 euros for math purposes. Okay? And when you come back, you have to convert those euros back to dollars. And you realize that you've made a very small, minute amount of money. Now, it's not going to be a lot, but you realize you made a little bit of money. And you wonder, why did I leave the U.S. with 1,000, but I came back with a little over 1,000? So what you have just done is participate in Forex. And all we do here at the CPSG Academy And in this 18-day boot camp is we teach you how to do this day by day from your phone or laptop. And what you're seeing on the charts and what you will see on the charts is the same thing as what you just did there in the airport. So this conversion is the exact same as what you're about to learn to do. All right. Now, as you begin, one of the questions you may ask yourself is, why would I trade Forex? Why not do something else? And so here are just a couple highlighted points, that I think are important to remember. First is low to no commission. And for those of you guys that don't know what that means, I'll go through each point here. A commission is when you take a position on a trade, when you open a trade, when you buy a currency and you try to make money. What the broker will do is they will take a little or none commission. Go over to a different market, say a commodity market or indices market or any sort of investment. Sometimes this commission can be extremely high and they can take a lot of that money initially. And so this, what it allows for is a lower barrier for entry. And it allows people to get started with less, which leads me right to my second point, which is a low spread. Now obviously a spread is a word that you have not heard yet, and we will discuss it in today's video. But a spread is another way for a broker to make money. Just know that it's very low, and it's just much easier, and once again is a lower barrier for entry. And we'll discuss the spread in just a little bit here. Also, there's no fixed lot size, which, as we discussed in day 2 when we're talking about measuring that 2% risk, we now know that there is no fixed lot size. So you can tailor that lot size to the account, meaning how much money you have in your account. Also, the one reason that I got started years ago was the fact that it is open 24 hours a day, 5 days a week. This was a big deal for me and many others around me that were getting started, because for me at the time when I first got started, I was just getting out of high school and I was just coming into college. Well, obviously, as you guys know, college takes a lot of time. So I didn't have time during the day-to-day trade. Well, with the Forex market, I could get off school, I could go home, I could go study, and then suddenly when I was finally done and the night came to an end, I could lay in bed or I could sit at my desk and look at the charts. It gave me that freedom. The stock market didn't do that for me. Commodities didn't do that for me. So this is a big thing for a lot of people. Now, leverage is another big thing. And leverage is something, once again, another term I do not expect you to know. And in today's video, we will discuss it. But leverage is another big deal because we are able to leverage money that we don't have to make money. And that's a big deal for another low barrier for entry, meaning it costs very little or a smaller investment than other ventures. It is also a heavily liquid market, which what that means is that there's, of course, over 5 trillion a day traded. There's a lot of money out there. So if you come in, you're wondering how much money can I potentially make, the sky is truly the limit. It's just going to come down with your skill set, your investment, and your attention to detail through these days, and of course into the future after you're trading alone. And finally, it's easily started. As we saw in day 1, setting up a broker account was a Google search away. It's not anything that's very difficult. There's not much paperwork. You have to go through, yes, a little bit, but it's nowhere near as much as if you were to go to a portfolio manager. I'll even use mine, for example. When I went into one of my portfolio managers for my bigger accounts and for my long-term retirement type investments, and I utilize those for write-offs and some other digress information. But the paperwork just alone took hours from a meeting standpoint. With Forex, it just takes a couple clicks of a button on a computer screen and you're started. All right? And so let's first get into a little bit of this information and what we can do with it. So first, since the market is traded 24 hours a day, traders are participating in 4 different sessions. So keep in mind that the market session desk is not always in one location. It's moving all around the clock, and the main central location for it is constantly moving around the clock. So these sessions don't really have much to do with your trading style today, but they're just needed to be known, and I need to give you the basics so you understand that there are different sessions. So we do have a Sydney session, we have a Tokyo session, a London session, and a New York session. Now obviously there's different areas of liquidity, and the gap between this London close and this New York open is a big deal. This is when we see the most liquid market and the fastest moving market. And what that means essentially is that there's the most traders in there. And so what you have to look at is just what session are you trading in? And we're going to be trading different sessions, and I'm going to show you different techniques for sessions. But one of the things that you need to know is just the fact that there are different sessions. And so if you ever catch yourself wondering, well, why do I get off work, at 6 p.m. Eastern or 7 p.m. Eastern, and the markets are never moving? But why do I get up and before I go to work, I check out, and I look at the market and they're always moving and they're moving quickly? This is a question that you ask yourself. Well, it's all to do with the liquidity and the amount of traders in the market. And the more traders that are in the market and the more traders that are active, the more the market is going to move. And this is a very important thing that people forget consistently and that people forget to kind of put in the back burner, is the fact that you need to trade when the market is most active. You need to trade when there's the most traders in the market. And so take a look at this and understand that London and New York are predominantly the heaviest moving times in this market, and that's the time to take advantage of trading. So, what can I trade? So first of all, just know that there's a lot of currencies, a lot more than you probably even know exist. Most brokers typically offer between 35 and 40. Mostly it's a 39 consistent basis. Okay? What you need to know is what they mean. Traders make money off of buying and selling currencies at the same time based off of an exchange rate. This is the ratio of the value of one currency to another. So when you first come in this market, you're thinking, well, Patrick, how would I ever know what the US dollar is going to be doing? How would I ever know what the euro is doing? We pay less attention to the actual currency pair and more at what the charts are telling us. But what I'm going to show you now over the course of the next few minutes is just how it works and how there's money made. So currencies are quoted in pairs, and the pairs are always 6 letters. The first 3 letters in euro, as you see here, and the second 3 letters in USD. And this is going to be different. There's, of course, yen, there's pound, there's Swiss, tons of different things we'll discuss. But there's always 6 letters a slash, and there's 3 and 3. And what you have to understand is that the strength of one is always over the other. And so what we always do, and I'm going to pull my pen out, what we always do is break these first to the second. And so the first tells us one thing and the second tells us another. And what this means in the upward direction and downward direction is when the market is moving up, it means these 3 letters are stronger. When the market is moving down, it means these 3 letters are stronger. When the market is doing this, it means neither of them are really stronger than either, and the market is essentially stable and going sideways. And so each position you place, keep in mind, you're not just buying one currency. You're doing both a buying and a selling transaction of each currency at the same time. So if I think the market on Euro USD, if I think the chart's going to go up, I'm buying the euro and selling the USD. I'm buying the euro and selling the USD. This is important because this gives us leeway. Why? Because we can then go vice versa and we can buy the USD and sell the euro. And then if the market goes down, we make money. And we'll discuss that here in a little bit. But it puts less risk on shorting the market for those of you guys that know what that means. So let's get into it. Here's an example of Euro USD. First 3 letters is in blue, second 3 in a tan brown, whatever you want to call it. Okay, first 3 are known as the base currency. That's what the base is. That's what we're starting at. The second 3 is the quote. That's what it's based off of. So when placing a position on euro dollar, the exchange rate tells you how much you have to pay in quote to buy 1 unit of the base. So the type of trade you take revolves around the base. If you believe the euro dollar chart will rise, you will be buying the euro and selling the dollar. Hence, if the euro gains value over the dollar, the chart will rise. So let's take a look at this. This is euro dollar on a 1-hour chart. Notice that predominantly, what do you think the direction of this chart is showing us? It's going up and up. And I don't expect you to know about these charts. We haven't even gotten into it. I'm just giving you the bare bone basics. And tomorrow, in day 4, we'll actually start getting on MetaTrader 4 and looking at a chart. But take a look at this. What direction is it going up? Is it going? It's going up, right? And so predominantly in these swings, the euro is stronger than the dollar. The euro is stronger than the dollar. When the market starts moving down like it is here, the dollar is stronger than the euro. Now, I do not expect you right now to know when to buy or when to sell each currency pair. It's just imperative that you know why the chart is moving the way it is. It's very simple. Think about it this way. If we have 100 people trading in a market and they're trading this chart here, Euro USD. Okay, there's 100 people total trading it. And they all are trading the same amount of money. If 85 of the 100 and 15 of the 100 were if 85 of the 100 were trading the euro and 15 were buying the USD, what direction do you think would be stronger? The euro's direction, aka up. And so that's simply what trading is. Which direction has more money? Market is all based off of sentiment and speculation. So when traders are trading, they're trading off of the fact that they think. They don't know, but they think the value of something will go up. It's the same as the stock market. Take Tesla as an example. If I think that Tesla will be stronger in the next year, what would I probably do? Buy Tesla. It's the same with the euro. But we can do it on all time frames. This is the 1 hour time frame, and we'll get into what that means in the future. This is a very short time frame. As you can see over here, it says August 8th. Over here, it says August 22nd. Very short span of time. But in this span of time, the euro is much stronger, meaning more people were buying into the fact that the euro was strong than buying in the fact that the dollar was potentially strong. More people were trading and buying the euro than they were the dollar, and that is why the chart is moving up. So that's how these currency pairs work. So I've said a lot of stuff. I've thrown a lot of stuff at you. Now I need to start to throw you some terms so you can really start learning. Now, the first term I'm going to hit on is a pip. This is the term that predominantly you're going to hear every day that you trade. This is the term that people use, period. Now, if you've ever heard of the Dow, you know, in the stock market, if you ever hear of, say, the Dow, or if you ever hear people say, you know, anything was down 30 points or 100 points or whatever the case may be, it is not the same in the Forex market. A pip is the most common term you'll hear in the Forex market, but is different than a point. So a pip simply means percentage in points, which is the smallest increment of price movement any currency can make. So 100 pips equals 1 point. So we've been talking about euro dollar. Let's continue talking about it. If a currency's price, say euro dollar, moves from 1.27 to 1.2655, you can easily find out how many pips it has moved by subtracting the two. And if you don't want to do math, I'm going to show you in tomorrow's video over the chart itself how to do this, you know, with technology. But all we're doing is subtracting that 1.27 minus that 1.265, and that is 45 pips. And so if you're taking what's called a mini, which we'll get into that in the future, a mini stands for entering a trade at 0.10. And if you guys are following along in your workbook, it should actually have that down there for you. If you are taking a mini, a 0.10 looks a lot like a dime, but it has nothing to do with a dime. What a mini does is it makes you $1 per pip in profit. So if every pip you go in profit, you make $1 off of a mini when you enter the market, then if you have a 45 pip profit trade, how much will you make? $45. Correct. Okay? So a pip, just know that we will be able to measure it on the chart. But understand that a pip is not a point, and you have to understand how to measure this. Because it is imperative to be able to measure a pip to get back to that day 2 segment of risk reward. when we talked about risk reward in day 2, you need to know how to measure a pip. And if you can't measure a pip, you can't measure a risk reward. Very important. So the next term that you'll hear often is a spread. Now, we talked about it earlier and I said I'd explain it, so here we are. A spread is very similar to a business. So Forex is a business. Someone is making money every time you trade. And so think about it this way. There's a middleman in between you and your trade. And this middleman is the broker that you opened. And he is providing us with the opportunity to actually trade in the market. And so there's always going to be a difference between the ask and the bid price in your broker. Now, when I look at this bid price, notice it says 116.98 and this one says 117.07. When I look at these prices, notice that they are different. You guys see that? If you can't see that, try to pause it and zoom in. One says 116.98 or 989 and one says 117.070. The difference between this is known as the spread. So I must say, disclaimer real quick, every time you enter a trade, you're immediately going to be at a loss. And you're always going to be negative when entering a trade, as it says down here. And the reason that is that the spread has not yet been filled. The reason a spread exists is not to hassle you, but there would not be brokers in a business because they wouldn't be making money. They'd be doing it for charity work. They want to make money, so they employ what's called a spread. And this spread is going to allow them to make money. So you're going to have to surpass this spread before you ever get into profit. Now, typically this spread is not large, but keep it in mind if you're trading a very short-term trade, because you never want to target less than your spread because you'll never make money. Okay, so understanding that the spread exists is so important. So now let's get into just a couple pair names. Now keep in mind, this is not all the pairs that you'll be trading, but these are predominantly what we will trade in the live rooms and predominantly what you'll see called, one way or the other with a combination in the signals. So be aware that many names traders, there's many traders that'll give pairs different names. And to keep it simple, I'm just going to tell you what I call things. And the majors are, there's basically two different types of situations we can have. We can have a cross pair or a major. And so some examples of majors are Euro dollar or Euro USD, pound dollar or pound USD, dollar yen, dollar Swiss, dollar CAD, Aussie dollar, things like this. And then some cross examples just cross these pairs up, as you can see here. Understanding this is not important to make you money, but it's important for terminology when I'm talking about them. Okay, so here's a couple nicknames that are commonly used, and you'll hear me use some of these in the live room, and it's just important for you to understand them so you know what pair I'm talking about. So USD JPY, a lot of times people will call it dollar yen. GBP USD, a lot of people will call it sterling cable or pound dollar. So I typically call it pound dollar. Euro dollar or euro for Euro USD. So as you can see, you can read through these, just write them down, or if you have the notebook, obviously just look at them. But keep in mind, all of these are going to be used and be mentioned in different ways. And so the easiest way that people like to refer to them is just as these, or just name them dollar yen, pound dollar, euro dollar, dollar Swiss, Aussie dollar, New Zealand dollar, or dollar CAD. Or you can use these ones as well. And some people even use their first letters as UJ, GU, EU. I don't necessarily do that because then sometimes there's different pairs that will have different letters such as UC, UC. So it doesn't really work for me. But utilize them and just understand the names to help you. And obviously clarification will come with time. There's no better learning tool than just being on the charts and being around the environment of trading, because this is going to change your life. So, once again, just similar pair names, Euro, US dollar, Japanese yen, British pound, Canadian dollar, New Zealand dollar, Australian dollar. These are just those major pairs that you will have to be accustomed to trading day in and day out. These are the most commonly traded pairs you will see in the signals in the live room, and of course talked about throughout the rest of this 18-day boot camp. Okay? Now, the next commonly used term that I've got to talk about, and this is kind of getting some boring section, but you need to know it, is leverage. And we talked about it earlier, how I said I'd mention it. So in the world of Forex, you know, leverage is an important factor, because if you don't understand it, it's going to burn you. It plays a vital role in the buying power of your account. The choice of leverage is offered upon the opening of a brokerage account and is what influences your purchasing power into a market. If you go back to day one, remember I mentioned regulated versus unregulated and the power of leverage? Well, understand that leverage is not as easily accessed on regulated brokers, but it's very easily accessed on unregulated brokers. I'm just going to be blunt with you because that's what I think this course is about. Beginner traders tend to use unregulated brokers and a lot of leverage. Why? It gives you an opportunity to make a lot of money with very little money. But think about it. It's a double-edged sword. You can also use it inappropriately, which I'll talk about in the next frame here, and you can actually lose money. So the textbook definition of leverage is having the ability to control a large amount of money using none or very little of your own money and borrowing the rest. This is just a definition that I found online of leverage. This has nothing to do with Forex. Leveraging is like a loan. You know, if you look at real estate and you look at investment properties, what do some people do? They will leverage a loan to buy a duplex or buy a single property home or buy an apartment complex. Heck, this might be some of you guys moving into investing now. You may have been leveraging all your life. They use that loan to then broker a deal to, you know, get a mortgage and get a payment going, but then rent that home or rent that apartment out. And when they rent it out, they're hoping to make a little bit of a profit. Well, leverage in Forex is very similar. You're using something that's not actually yours to try to make money in the future. So kind of to continue on this point, leverage is something that can be customized to gear up your account in order to execute a trade position greater than your actual balance. For example, if you have $5,000 of margin, or basically $5,000 of money in your account, and $500,000 position is opened, you have used a 100-to-1 leverage. You have leveraged your account 100 times. And so the important note of this is that there are brokers out there that allow you to leverage up to 3,000 times. So yes, if you open, say, a $1 million a position on an account, on that same account, guess what? You're 200 times over. So many amateurs step into trading with high hopes of using high leverage in order to achieve large gains. But it's important to note that leverage can magnify losses in an equal manner from wins. So when used inappropriately, you can lose a lot of money very quickly, as you can probably see now. So the calculation of leverage, which once again is not necessarily imperative to know, but I'd like to give you the framework of information over the course of these first, this first 5 or 6 days to make sure that you understand everything. So the calculation of leverage on a certain trading account is done by dividing the total value of open positions by the total margin or total amount displayed. For example, if you have 20,000 in your account and you open 2 standard lots on euro dollar, which is 200,000 units of a base currency for 200,000, your leverage ratio is 10-to-1. If you leverage 400-to-1, you control a large position with only $500. So you can see that leverage lets you basically, in a nutshell, to get out of leverage now. Leverage is going to allow you to trade more money with less. It's just like a loan, basically, to trade more money with less, but it can burn you both ways. All right, so the next housekeeping is margin. And before, margin is basically our last major term before we really get into start about trading here. So I'm going to take a quick drink here. Take a look at this. So margin is the amount required to open a new position. There's always something that is required to open a position in a trade. There's no way around it. And so with a $1,000 margin balance in your account, a 1% marginal requirement is required to open a position. You can buy or sell a position worth up, say, $100,000. This allows a trader to leverage their account up to 100 times or use that leverage. So the higher the leverage on a trading account, the higher the available margin percentage. If you open too many positions using high lot sizes or leave a trade running in an increasing loss scenario, then the account could fall under a minimal amount required to maintain an open position, as we just talked about. If this happens, we call this margin call. Believe me, you do not want to send me a message that said you hit margin call, because that tells you you're over leveraging the account. And so it is likely to occur, and more money will be required to be deposited into the account to close the position. Meaning, yes, you could deposit $300 in some brokers, say 300, 500, 1,000, and over leverage and be required to deposit more money to break even with the broker. So do not do this. Do not over leverage. Utilize what we said in day 2 on your opening account size. Utilize your minimum risk. Utilize your risk reward so that you never fall in this. You won't fall in this if you follow that. If you follow day 2, you will never have to worry about margin once. And so there's a lot of brokers out there that as well, that if you hit margin call, they will automatically cut the loss. And they will just basically exit the trade for you. And whatever loss you had, it's gone. You're done. You don't have that money any longer. You don't owe the broker any money, but you just lost without wanting to. So when trading in high leverage, you need to be careful and aware of many positions you could open at the same time, taking into consideration the balance of your account. For instance, on a 400-to-1 leverage account, 2 standard lots, which equals $20 per pip, would be way too big for a $2,000 account, as once the margin has been taken into consideration, you'd only have around $1,300 left on your available equity, which is around 65 pips against you, and you're wiped out. As a result, it's wise to use a lot size in accordance to money management ratios, which I love that last line there, if there's any line I want of importance, because this segment's the most boring for me to talk about, to be honest with you, because it's all definitions and it's all, you know, everybody can talk about it. It's just boring, right? But you need to know it. But that bottom one's important. As a result, it's wise to calculate lot sizes. And so utilize what we talked about in day 2. Go back and refresh your memory. You have to use that when we start entering trades. So now that we've covered these definitions, let's get into some important stuff. First things first, types of trades. Depending on the type of trade you're taking, you may want to enter different types of trades. Brokers allow you to control this. And so what I'm going to talk about right now is different type of trades. And the first one I'm going to talk about is what's called a market execution. So what this means is if you wish to enter the market at the current live market price, meaning you're sitting at your desk now, whatever time you're listening to this, if the markets are of course open, if it's not the weekend. If you're listening to this video right now on a weekday, okay, and you want to enter the market right now, and you hit enter, that is what's called a market execution. It's instantaneous, and it enters the market basically in milliseconds off of your broker. And so what I did was I circled there, this is off of an MT4, this is off of a desktop trading panel. When you hit new trade, it will say type. See how it says market execution? I circled it there in blue. When you hit sell by market down there in the red or in the blue where it says buy by market, when you hit that, you will automatically enter the trade at that time. Okay? You will automatically enter the trade at that time. So just know this. This is just information to know and learn. Now, secondly, is limit orders or stop orders. Now, if you do know me, obviously you know where I'm going to go with this. If you don't know me, welcome to Patrick's world. 95% of my trades are entered off of a pending order. Now, this I'm going to take some time explaining because it's very important. But I trade off of pending orders for a multitude of reasons. But the biggest reason is to do with my trick with money management. If I'm always entering off of pendings, I'm always given time to make sure I know where my stop, my entry price, and my target is at. And of course, when I do this and I enter a pending order, what it means is that I enter a specific price. And I don't want to enter the trade until that price is hit. So that means you set it in and the algorithm in the program will do the work for you. So yes, that means you could be at work, sleeping, eating, anything. And if the market hits that price, you'll get in. So let's take an example. Let's say you wanted to enter a market at the price of 1.35. All right, and this is 1.35. And the market's current price is down here, and it might be at 1.34. You get it for the, for the purposes of the example. This is 1.34. you can enter a pending order that says make something happen here at 1.35. And that something is one of these four options here. All right. And what you will see is under type, what you'll have to do for a pending order is click this little arrow and change it to pending order, which will then unlock a completely new screen. Notice on the market execution screen it says sell by market or buy by market. Whereas if you switch it to pending order, it will either say buy limit, sell limit, buy stop, or sell stop. So I'm of course going to teach you how to enter in the coming days. We don't have to worry about that now. We have to understand why and what they do. So here are the four options. We have a buy stop, a buy limit, a sell stop, or a sell limit. Let's keep this simple. A stop means that we're going to shatter through price in either direction. A limit, and then I'll explain, means we're going to reject off of price in either direction. So as you can see here, when we place a buy stop, we're placing orders above the current price. Meaning price is here, and we want to buy it when it hits here. Bingo, we entered the trade and it continues higher. A sell stop is the same thing on the other side. The price is here. Currently, we want to enter it at this line. Down it goes. Bingo, the trade is now opened. Okay, those are the stops. Limits are the same thing. A buy limit simply means the price is below us currently, and when the market comes down, bingo, we buy it. Sell limit is vice versa. Market comes up, bingo, we sell it. So same thing both directions. You need to know these. So write these down. And understanding that the limit is the rejection and the stop is the break will help you. And so what I'm doing right now is just kind of getting you through this panel to help you for entering trades in the future. So next slide here. The first thing I want to talk about is taking profit. We just talked about entering. We can enter off of what? Let's recap. Think about it in your head. We can enter off of a market execution, a limit, or a stop. Now we're going to talk about a take profit. So everybody, the number one goal is to take profit. And so the take profit is a price point which is defined by the trader as to where they wish to be automatically taken out of the trade once price reaches that specific level. And it's an order which is used by currency traders to specify the exact rate or number of pips where the trader wants to take profit. You need to have this to measure a risk reward, because a take profit is of course that reward part of the equation, and without having it you can't measure it. So you need to have it every time, and I'll teach you how to get one in the future, but right now I'm just going to show you where that is in the order panel. It's circled right here under the take profit, and you're going to put that number in there. And it's always displayed within the order box, so I just want you to be aware of what it is and what it means. So say we use gold, for example. And say gold is currently 1,300. And you entered at 1,300 for all intents and purposes. And you want to exit gold when it hits 1,400 an ounce. If the market decides to go up over the course of time and hits 1,400, and you put 1,400 right here in your take profit, regardless of what you're doing at that time, you're on the charts or not, the broker will automatically take you out at 1,400 and give you your profit. Take profits are great. We want them to be hit. That means we're making money here at CPSG. All right, next. Next is the stop loss, the opposite side of things, meaning when we're in that gold trade at 1,300, right, and we're targeting 1,400, we have to set a stop loss, say at 1,250, so that if things go bad, we get out before it goes even worse. All right, so first things first, a stop loss needs to always be used. And as you can see, the stop loss is no different than the take profit. You just plug that number in. So what that number I just talked about was 1,250. You type her right in here. All right, same thing, same thing. So always use one. And it's the most important aspect of understanding Forex. I promise you that. It's more important than taking profit. A stop loss is designed to limit a trader's loss on a position. And it's used for either a long or short position. And so understand that a long position, apologize about that, a long position is a fancy word for saying a buy or the market's going up. A short position, if you've ever heard of short selling, is a sell, the market's going down. All right? And we use them on either. And so a stop loss order takes the emotion out of the trade. Now, why would I say that? Why would I say that? Well, if you enter a trade and you're not too positive if it's going to go down that level or not, and you are, talking about potentially getting in the trade, etc., you do decide to enter, and then you're stressed about it, well, you automatically know that if it goes that bad, you have a stop loss in place that it won't take all your money. So you know that the market can't just keep going and going and going against you. And it's especially great when you're on a vacation or you can't watch the position, but it doesn't matter. You always have to use one. Always have to use one. So for example, let's say you execute a sell trade, like a short, like we talked about, meaning that you want the market to go down on pound dollar. Now this is probably coming full circle now. If you want the market to go down, which currency pair is stronger, pound or dollar? If it's going down, it's the second three letters, aka the dollar is now stronger. And you enter at, say, 1.673, and you're only prepared to lose a maximum of 40 pips on the trade. You would set your stop loss, of course, if you're shorting it, you're going down, you'd set it higher than your entry price at 1.677, 40 pips higher if you're selling. And the stop loss gets placed at a higher level than entry if you're buying, and the stop loss gets placed at a lower if you're selling, the stop loss gets placed at a higher level, and if you're buying, the stop loss gets placed at a lower level. This gives you safety if a trade goes against you. So, once again, to recap this slide, if I'm buying, and I'm buying here, my stop loss is below. If I'm selling here, just because I stuttered there for a second as I was trying to read, if I'm selling here, my stop loss goes above the sell. Okay? And so if I'm selling, I want the market to go down. If I'm buying, I want the market to go up. Once again, you have to use these, and I'll show you where to place these in the coming days. All right? So next, we are not done with day 3. Keep in mind, as I said, these days are going to get grueling. They're going to get longer, and it's going to take you some time. So take your time with these. If you have to break these videos up into multiple days into one day, that's fine. Meaning if day 3 takes you a week to get through, that's cool. I don't care. I want to make sure you actually go through this information. All right, so just had to take a drink. So now we're going to talk about the chart. Now, the chart is important. And so first things first, in CPSG, in this academy, in the 18-day boot camp, we're only going to teach you how to trade on candlestick charts. Now, there is no bias towards this other than the fact that that's where the experience comes. Therefore, this is what we will be covering only. However, be aware that there are both bar and line charts as well. And so candles are easier on the eye to read, which is why we use these in CPSG. So this right here is an example of a candlestick chart. And the reason it is, doesn't it look like a candle to you guys? Some of these little candle, little wick. And so I'll discuss with you guys what that means. On this left side, here you can see how these charts are actually made. Basically every single candle is created. And so when it's a green chart, or a green candle here, all it means is that whenever that candle opened, whenever it opened, it closed higher. And when it's red, whenever it opened, it closed lower. So let's say the chart opens here, the candle opens here. Say price moves down. You guys have watched this probably on your charts. It moves down, then suddenly it moves back up, then it moves down again, and it closes, new candle. That's how it's painted. Now, for some of you guys that are beginners, you might be asking, what do you mean it closes? Why does it ever end? Every chart is on a time frame, and time frames can be 1 minute, they can be 1 hour, they can be 1 day, they can be 1 week, they can be 1 month, and everything in between. What that time frame stands for is how long it takes to create the candle. So to paint this picture clear for you, let's say we're on a 1 hour, this is a 1 hour chart here that you see. That's a 1 hour chart. What would that mean? That means that every single one of these takes 1 hour to be created. Once that 1 hour passes, a new one starts. So that means that this candle here that I'm hovering on the bottom, that's 1 hour. This is 2. This is 3 hours, 4 hours, 5 hours, 6. 24 candles equals a day. Now, speaking of day, what if this was a day chart? 1 day, 2 day, 3 day, meaning it takes a full day to create that candle. So as you can see, the higher the time frame, the less small movement you'll see. It'll be more of the true action of the chart, which is why we are talking a lot about high time frame stuff coming here in the future. So to talk about this more, the upper vertical wick is known as the upper shadow, and the bottom is known as the lower shadow. Upper shadow, lower shadow. Okay? And the main difference between candlestick and bar is how it displays the opening and closing price. The body of the candle and the block of the candlestick indicates the range between the opening and closing, right here. Here's the open, here's the close. It's just showing you and coloring it in where it was at. Okay, and this is just for the green side. And the wick lets the trader know where price has actually gone at one point before closing. So the wick is just showing where price has gone. Now keep in mind, back to the basics, the only reason this chart moves is if there's more buyers or sellers. So if there's a bullish candle, meaning it's going up, it's going higher is bull, it's going lower, it's bear. How I always talk about that to beginners, if it's a bullish candle, it means buying, it's going upward. What does a bull like to do when they run at you with their horns? They put them down and they raise them up. What does a bear like to do when they attack? They bear down, they go down at you. Okay? So understand that, and understand that. And so if the body is red, it indicates that the price is currently closing lower than when it opened. So back and forth, it's the same thing, just vice versa. Okay? So this is very important to remember as far as the candlestick charts. And this is kind of a point where people will probably get more so kind of stuck up on things. So make sure that you get this. Make sure you understand why the candle moves the way it does and why this is the way it is. And so get ready, because these candlesticks are going to be set up tomorrow in day 4, where we will discuss the platform. And the platform we will discuss is MetaTrader 4, which I asked you in day 1 to download. Okay? So once again, guys, this has been Patrick. This is day 3, and we have completed day 3 of the boot camp. Now, once again, this is an 18-day series, and we have yet to talk about any sort of trading tactics. Day 4, just to give you an idea, we're about to get into some tactics. We're about to set up our charts. Then day 5, day 6, and all the way through to day 18, it's nothing but tactical movement. So up to this point, guys, I want you to make sure that these 3 days make sense. They have to. It is imperative that you understand specifically all this information up to this point, because without the terminology, without the understanding of risk, without having a broker, without having MetaTrader 4, you can't succeed. So be sure you have it down. Watch it a couple times. Take great notes. And I will see you guys back here for day 4. God bless.